Absolutely. Let's start out with PPI, then we'll go to retail sales. February PPI headline number expected to be up 0.3%. Zoom, 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 up double, up 0.6%. That would be the hottest going back to, well, equals July of last year. To find a higher number, you're going back to June of 22 when it was up 0.9%.
Coming up in today's review, stocks finish lower on the back of more hot inflation data, how crypto is contributing to inflation, a look at MicroStrategy's valuation, why investors have reason to worry, oil breaks out higher, and former Treasury Secretary Stephen Mnuchin is attempting to buy TikTok. And surprise, surprise, we got some more hot inflation data, which gave us another interesting day on Wall Street. Was pretty bearish across the board, led down again by semiconductors, which we're continuing to see more volatility in the sector, along with another fall for Tesla, and yield-sensitive sectors of REITs and utilities fell as well. Got a bit of a bump up in bond yields. On the back of higher crude prices, we saw energy, oil and gas have another good day, and interesting, a little bit of a rotation into some mega cap tech names like Alphabet, Apple, ones that have been weak recently, and actually new all-time highs for Microsoft. And so we got some important inflation data today. That's the producer price index, which is basically a measure of big cost inputs into a lot of our products and services, a lot of things to do with commodities and energy. And that was quite the beat. Consensus from economists, where it's going to grow 0.3% month over month, actually came in double 0.6%, which annualized is over 7%. This is definitely not low inflation. However, the stock market held up pretty well given that number, finishing the day down on the S&P only 20 basis points, not much at all. And just going down to the 5-minute chart, right up until the last half an hour of trading, we're down about 0.8%. However, we had a bit of a buy the dip into the session close here. And so it's quite remarkable, the stock market just holding up in the face of these higher than expected inflation prints, especially when this whole rally, which kicked off in late October, was based on the Fed pivot, the view that inflation's coming down, and back here the market was hoping the Fed was going to cut rates 6 times this year, whereas now it's looking like they'll have to get lucky for the Fed to even cut 3 times. And the more we get these hotter inflation prints, the more that just denies Jay Powell from pleasing his masters from cutting rates, as it'll be too obvious a political maneuver for him to go ahead and do that. So even though there was a bit of bearish breadth, especially in yield-sensitive sectors like clean energy, falling the most today, 2.81%. Regional banks not liking this move up in bond yields. Small caps came off. Same with home builders and semiconductors. Parabolic uptrend looks to still be intact. We haven't even taken out lows from Tuesday's session. And even though we got a bit of a spike today in the VIX, getting to 15.3, still pretty low here. Market doesn't really seem too phased by this higher inflation. We also got a read on retail spending for the month of February. And even though that increased, came in a bit below expectations, rising 0.6%, below what economists thought it would come in at 0.8%. And so just looking at a long-term monthly chart, S&P 500, stocks ripped up into late 21. Then we started to see more and more signs of increasing inflation. It became obvious the Fed had to hike rates, which they did do their most aggressive rate hiking cycle in history, which did knock stocks down a modest 27%, nowhere near other bear markets the S&P has seen in the past. And it helped to get crude lower as well and did bring inflation down a bit. But even though the Fed did their most aggressive rate hiking cycle in history, maybe they didn't go far enough with their rate hikes, maybe needed another percent or so. Because we know at the very least, we've got inflation back in the stock market, property market, holding on to its inflation. However, a lot of people consider that good inflation because their stocks and properties going up. What they don't want going up, Fed and the government, is commodities. That's bad inflation. And there's a look at the overall commodity index, ETF DBC. It's kind of holding ground here. We're already seeing upticks in inflation. There's a look at the monthly chart in crude oil. Basically just forming a base, hasn't even really broken out yet. Again, we're already seeing inflation ticking up. And we've got a bit of an uptick and breakout in the agricultural ETF DBA. And that's even with weak corn and wheat prices as well. And these are 2 really big cost inputs into our food. In fact, over a third of the world's calories is derived from these 2 commodities, wheat and corn. It's also really important for farming and animal feed and some other industrial uses as well. So we'll be keeping an eye on wheat and corn to see if they start upticking again, because that's really going to add upside inflation into our food. And there's a look at gasoline futures, actually finishing up today, but like crude, you could say it's pretty much still on a sideways trend this last half year or so. But we've already got shipping and cargo rates well off their bottom lows, and that can flow in to the cost of everything else that they help transport as well, just with a bit of lag. So this latest PPI report is no doubt a thorn in the Fed's side. They don't want to see month-over-month increases come in and double than expected. And a big part of this increase had to do with a 4.4% surge in energy prices, which eventually contributes to a worsening of goods inflation. And remember, everything takes energy to make or deliver, and so it kind of all starts with energy. High energy prices translates into higher everything prices. And one thing that could be contributing and exacerbating that trend is the explosion in crypto again to new all-time highs. Because you got to remember, with Bitcoin, yes, it's finite and scarce like other commodities. However, unlike other commodities, it doesn't power the world, it actually chews power. And there's a positive correlation with the price of Bitcoin and its energy consumption as more and more miners enter the game, as it becomes more and more profitable. With the reward, when converted to US dollars, increases with the price of Bitcoin. And not only that, AI as well uses an incredible amount of power. We can see some expectations that data centers are expected to triple their power consumption in the US over the next 7 years. And just last year in the US alone, crypto mining accounted for between 0.6 and 2.3% of the country's electricity demand. So that's likely to come in a lot higher this year with the explosion of the price in Bitcoin. And the higher we go, the more and more miners are going to join the party, and it just becomes a self-perpetuating cycle. With even billionaire hedge fund manager Bill Ackman posting on X a cryptic and hypothetical scenario saying Bitcoin price rise leads to increased mining and greater energy use, driving up the cost of energy, causing inflation to rise and the dollar to decline, driving demand for Bitcoin and increased mining, which then drives demand for energy, and the cycle continues. Bitcoin goes to infinity, energy prices skyrocket, and the economy collapses. Maybe I should buy some Bitcoin. And so what is the end game for Bitcoin? All the whales are pretty much just trying to corner it and hype it up, pump it up in a classic Ponzi scheme, get everyone piled on top of them. And then what happens if Bitcoin reaches $1 million a coin? And then we've got clowns like Michael Saylor becoming the richest people in the world. Should business schools start doing case studies on him for their students on how to be successful in business, to corner a finite fake currency and then go on podcasts all day, reeling in other investors on top of him? Is that the new formula for success? Even though it's working really well for him now. What he's essentially doing is levering up the whole Bitcoin market by constantly selling debt and then turning around and buying Bitcoin, of which he owns about 1% of the entire supply now. And I'm saying it's the best investment asset. So the end game is to acquire more Bitcoin. Whoever gets the most Bitcoin wins. There is no other end game. And he's planning to offer another 500 million of convertible debt to keep buying up Bitcoin. So he's basically just trying to buy up as much as possible with his pump and dump vehicle MicroStrategy, now owning 205,000 Bitcoins. And there's a look at Bitcoin today, falling 3%, still holding ground above 70,000. And since the start of this year, it's currently up about 57%. However, MicroStrategy this year is up a whopping 166%, more than 3 times the gain of the underlying. And so let's just take a quick look at the valuation. Currently with a market cap of 28.45 billion, and their underlying software business, which is pretty much just an old legacy product with a few enterprise customers locked in, flatlining revenue over the last 5 years, coming in just under 500 million. So let's try and put a value on MicroStrategy's enterprise software business by looking at the valuation of the largest enterprise software company out there, Oracle. And they've got a market cap of 345 billion, with most recent annual sales about 50 billion. So to work out the price to sales, we start with 345 billion market cap, divide that by 50 billion in sales, gives us a price to sales of 6.9. And let's not forget, Oracle's a high quality brand and is actually growing their revenue over the last 5 years, whereas MicroStrategy is not. It's flatlining revenue over the last 5 years. However, let's be generous and give them the same price to sales on their business as Oracle, 6.9. So MicroStrategy's 496 million revenue multiplied by 6.9 gives us 3,422. That's 3.4 billion. And again, that's a generous estimate given there's no growth there, giving them a price to sales just under 7. Okay, so 3.4 billion. Now let's value their Bitcoin on the balance sheet. They've got 205,000 Bitcoins, currently trading at 70,700 a coin. That gives us a value of about 14.5 billion. So 14.5 billion plus the 3.4 billion for the value of the business gives us a total valuation of 17.9. And the market cap is currently 28.45 billion, which is approximately 58% higher than the valuation we just worked out. So with the current stock price at $16.76, it should be about 40% lower, around $1,000 a share. And remember, that's been generous, assigning their non-growing business a price to sales of 7 and assuming the price of Bitcoin holds up as well. So the market for MicroStrategy's clearly got ahead of itself. We can also see that in the frenzy in the options market, because even though it's only got a $28 billion market cap, it's constantly showing up near the top of the leaderboard with multiples of call options being traded versus puts. So that begs two questions. Has Michael Saylor cracked the code of capitalism and has found a loophole where he can just continue selling low-cost debt in fiat currency, turn around, put it all into Bitcoin, and keep doing that until he corners as much of the market as possible? Even though Bitcoin has no real-world utility, is a non-productive asset that doesn't yield anything, or is economic reality and just common sense going to come back into markets at some point? Well, if it does, there's a certain way this can be played. And let me just first state, this is not financial advice. This is a very risky trade, what I'm about to say. And MicroStrategy could still go on a short squeeze. And who knows, even go up to $2,000, $3,000 a share. Anything can happen in the short term in markets, especially in a short squeeze. However, one way to play a potential correction in MicroStrategy's valuation, if things do come back down to earth, is to go long the BlackRock Bitcoin Trust IBIT, short MicroStrategy. And there's a look at the spread chart between the two. And so ever since the Bitcoin Trust came onto the market, this spread is down a huge 52%, meaning MicroStrategy, just in the last 2 months alone, has outperformed the Bitcoin Trust by more than 52%. And so a potential way to play this is to dollar cost average with small positions, because like I said, shorting a stock like MicroStrategy is very risky. And so dollar cost averaging with small positions and then looking for this spread to come back to positive, which is likely to happen when we inevitably get that correction in Bitcoin. MicroStrategy is a highly levered play on Bitcoin. It's likely to crash a lot more than the underlying itself. And there's a look at the monthly chart of MicroStrategy, even getting above the last run up in February 21. And just remember, this is Michael Saylor's pump and dump vehicle. The man's a borderline convict. He's been charged with fraud numerous times over his career, and he's no stranger to pump and dump. He was doing the same thing in the late 90s. With MicroStrategy, pumped the stock up above $3,000 a share before it collapsed over 99%, along with the Nasdaq bear market as well at that time. And just like the late 90s and the last rip in 2021, he is offloading a lot of shares himself personally in MicroStrategy. Even this month alone, he's offloaded over $15 million worth of shares, because that's his whole strategy, is to go around media and podcasts all day, pumping up Bitcoin, pumping up his stock, and then selling into the heights because he knows it's not going to last forever. But apparently, this is the new way to be successful these days, because it's obviously been working for him for over 20 years now. And so who knows, Bitcoin could hit $100,000 a coin soon, could go on to 200,000 or even more, taking MicroStrategy with it. But the more he does this strategy of raising finance and turning it around, putting it into Bitcoin, the more he's just levering up the whole Bitcoin price itself, which is going to inevitably create a lot more volatility when it does have its correction, if not crash. And then he'll probably turn around and blame it on the government or someone else, and again take zero accountability. And so just stepping back out to the macro view again, with stocks ripping up, crypto ripping up, using more energy, this is going to spill over into other areas of the market, and likely the Fed's preferred inflation gauge, that is personal consumption expenditures, which we'll get a read on later this month, and bond yields starting to change their tune a bit more as well, climbing up here today. The 2-year sitting at 4.69, and a bit of bear steepening in the curve. We can see that with a bigger increase in the 10-year, up 10 basis points today to 4.29. And so even though we didn't really see much of a reaction in the stock market, S&P pretty much finished flat. So inflation's starting to spook bond investors a little bit. But maybe why stocks held up so good today is because Fed Fund futures still pretty much pricing in a much better than not chance the Fed will still cut in June, which is kind of crazy to think. All these hot inflation prints. Inflation has at least stalled out, if not ticking up again, and the market still thinks the Fed is going to start cutting soon. But if that pricing were to change, and the bond and Fed Fund futures market thinks the Fed's not going to cut this year, then that should be the biggest threat to high-flying stocks, and likely to knock them off their perch, and we see a proper, at least 5-10% correction. And if the Fed itself had to come out and say we can't cut rates now and actually hint at raising rates, we're likely to see VIX 30 the next minute, and the whole picture in financial markets could change very abruptly. Not to mention upsetting the narrative for Biden, who's already going around telling people the little outfit known as Federal Reserve, they're going to drop rates soon. And not everything's rosy in the macro backdrop either. We've got corporate defaults happening at the fastest pace since the financial crisis, not just in the US, but around the world as well. We can see that in the year-to-date default count, already the highest since the great financial crisis back in 2009. Another similarity to back then, which I remember as well, there was a lot of calls for problems in the real estate market and recession in 2006 going into 2007, and the market just kept rising, and a lot of people abandoned those calls for a recession like we've seen over the last couple of months. And so if we did get one, that would catch a lot of people and the market by surprise as well, because that would come at a time, just like in 2007, of near peak bullish investor sentiment, like we can see here in the green line. Investors just as bullish as they were in 2021, with the bears nowhere to be seen either. We also had a huge outperformance in momentum stocks, currently at an all-time high, with their weight of the S&P 500. And that's measured by the 12-month return and looking at the top decile. That's the top 10%. That's above 2000, even above the old Magnificent 7 in the late 60s, which they called the Nifty 50, and even above 1929. Not only that, we're back to the crazy statistic which we saw in the COVID bull market into 2021, and that's the notional options volume, exceeding that of the notional shares volume, which means there's more money sloshing around in options than there is in the underlying stocks they're based on. Again, another sign of the froth in this market. And it's not surprising we've got this froth. The market's been on a parabolic rip for about 5 months now. And what you're looking at here is the annual performance versus the intra-year drawdown. So on the x-axis down the bottom here is the max intra-year drawdown, the biggest drawdown the S&P had during the year. Then on the y-axis is the S&P 500 annual performance. So on average, the market will have an intra-year drawdown about 14.8% and returns a little less than 10%. Here we are in 2024, almost reached an average year's annual gain already with an intra-year drawdown of just 1.7%. We haven't even had more than a 2% dip this year. And just looking back in history, since 1945, the market has never finished the year without having an intra-year drawdown of at least 2-3%, and that's only occurred a couple of times as well. So we very well could get that drawdown of 15%, even if we end up finishing the year higher, which in election year seasonality and some other medium-term technical signals strongly suggest that we should finish the year higher. And no doubt mega cap tech companies are more profitable than they are now, relatively speaking, to the late 90s. That's why we've still got analysts saying things like NVIDIA stock still isn't expensive, even at a true $1 trillion valuation, because it's now trading at a forward PE ratio that's lower than it was in November 2022. And we're still getting articles like this: run with the bulls, don't worry about the S&P until it reaches 6250. However, we may have already seen the majority of gains for the S&P this year. Currently up 8% year to date, and like I said, the forecasts are it should finish higher. But maybe we could get that 15% drawdown and still finish up 10% higher, especially if we keep getting big inputs into our inflation like oil continuing to break out. It's kind of really hard for inflation to come down in that scenario, with the price just settling at a 4-month high today after the International Energy Agency lifted its forecast for oil demand growth this year and also reducing its outlook for supply from countries outside of OPEC. And this is when OPEC, led by the Saudis, still want to cut production to bump up the price a bit, which is a move the world's third largest oil producer, Russia, is backing as well, even though they're worried about losing more market share to the US, which has been the world's biggest oil producer for a few years now. And there's a look at crude today, now holding ground above $81 a barrel, which is a multi-month breakout and looks to be in a bit of a short-term uptrend now. However, it's still got some technical work to do, especially on the weekly chart, to kind of break out from this base it's had for over a year and get its way back to those highs at $95 a barrel we saw just before the outbreak of the Israel-Hamas war. And even though Trump tried to force the sale of TikTok back in 2020, it didn't get through. However, it looks like this government is going to get it done because of political reasons, with TikTok owned by Chinese company ByteDance, and a lot of strong evidence that there's strong political influence in the content that TikTok pushes out to the 170 million plus Americans in favor of Chinese politics, not to mention privacy and security issues. It's looking like they will force the sale, and we've got former Treasury Secretary Stephen Mnuchin throwing his hat into the ring with his hedge fund looking to try and buy it. And this could be a really big deal if he manages to pull it off, with him confident the government is going to approve it, saying this should be owned by US businesses. There's no way that the Chinese would ever let a US company own something like this in China. And which is true. Big US tech companies, Google, Facebook, YouTube, Instagram, they're all banned in China, as the Chinese government heavily censor all content that its citizens see. And so this will be a big sale, with ByteDance valued at $220 billion at its last funding round. That's its global business, but its sale price for its US division could potentially be half of that. And I bet Meta's Mark Zuckerberg's probably not too happy with that going into US hands, as it's really his biggest competitor out there. And it could potentially see other bidders, maybe Amazon, Microsoft, Alphabet. However, they may not want to do that, as regulators may try and block the deal. Obviously, Meta can't do it. There'll be too much of a monopoly on social media, which they already have. Others are mentioning Oracle. I don't think so, because that's too big a deal relative to their market cap. Apple could pull it off financially, and they don't really have a presence in social media, and that could get favorable investor sentiment back to Apple stock, which it really needs at the moment. But either way, it looks like the Chinese will no longer have a direct line into 170 million Americans' smartphones anymore. Moving on, we've still got the fear and greed index seemingly stuck in the greed zone now, which it has been for 4 months and counting. And once again, corporate insiders still selling at a heavy clip relative to their buying. And just getting back into the charts, there's a look at high yield bonds coming off a little bit today. Dollar index didn't really spike up too much with bond yields, but still holding ground around 103. It's gold still consolidating just below all-time highs. There's the breakout in gas. Copper also popped up yesterday. A little bit of a pullback in Chinese securities. And clean energy looks to have lost its support zone. The back of higher rates, which the sector really doesn't like, finishing down today 2.8% on more than double average volume. It was a bearish Thursday for all international stock indices. And even though we saw a bit of a sell down in high beta stocks versus low volatility, that didn't translate into a higher value versus growth spread. Because like I said, we had a few of those big mega cap tech stocks rise today: Alphabet, Apple and Microsoft. There's the hottest sector, semiconductor, still holding ground above its 50-day VWAP. So this is just a short-term pullback at best. Same with other leading sectors like home builders, industrials holding up there. Energy was the winner today, starting to walk the line here. See some momentum, trend coming back into the sector. Regional banks don't like those higher rates. It's not good for their bonds on the balance sheet. Dividend stocks, the worst performing factor today, with growth actually holding up the best. And there's a look at Apple, finishing up 1%. Microsoft, all-time high, up 2.4%. NVDA a bit weak today, down 3.2%. Alphabet reclaiming its 50-day VWAP. And more weakness for Tesla, falling 4.1%. And some other hot stocks coming off: Super Microcomputer, AMD, Coinbase. Just had Adobe report earnings, and even though they came in better than expected, market obviously didn't like the outlook. Currently down about 10% after hours. And these other assorted hot stocks still held up there today. Even Wingstop increasing 1.7%. But a bit of a sharp turn down in the regionals, and even the big banks came off a little bit. But their uptrends are still intact, just like the S&P 500's uptrend is still intact. We don't have that technical confirmation, and my risk on, risk off indicator is still in risk on mode. Last time it was in risk off was back in mid-September. Market had clearly lost a bit of its momentum there before it found a bottom. And so even though we do got a bit of weakness in the leading sectors up front, most of them are still above their 20-day and 50-day moving averages. So like I said, high inflation, it's not even phasing this market. It's still pricing in rate cuts in June. But how many more higher inflation prints do we have to get for that narrative to break? Because this whole rally's been based on lower inflation and several or more rate cuts this year. And who knows, J. Powell may just go ahead and do it anyway, regardless of the inflation readings, because there's more important things here and now to accomplish. That's all I got for you today. Thanks very much for tuning in to the Daily Review, and I look forward to seeing you again for the last trading day of the week tomorrow night. Cheers.